big package, and it comes with also the rate cuts that we've seen, and I think is a pretty meaningful intervention, and there's no point in doing it just once. If you're going to do something of that size, you've got to be committed to continue for some time. So I think it is a really positive sign. Clearly it's a reflection of both the weakness in the domestic economy that's been gathering pace, but also the significant weakness we've seen in the equity market. And I think they really want to put a line under that and show that they are prepared to intervene to stimulate growth and meet their growth objectives and targets over the course of the next year or so. So it's a good thing for China, and of course, by implication, it's a good thing for the global economy given the size of China and its relevance in emerging market indices from an equity perspective as well.
Yeah, that's interesting because many markets, especially the one we are here right now in Germany, is very much dependent on what happens in China because the companies are so dependent on. So is that first like a positive, at least a silver lining on the horizon that China could actually come back?
Yes, I mean, there are structural longer-term problems. That's true of many places, of course, and we have to recognise that the Chinese economy is on a slowing trajectory in its economy relative to what we've seen in the last couple of decades. Part of that reflects changes in demographics, for example, and also to some degree a change in domestic policies and focus on things like common prosperity. But to the extent that there's going to be more focus on growth, that will be positive for places like Europe and Germany that have a lot of exposure to end demand in that market. And certainly from a sentiment perspective, I think this will be taken well, not just in China, but also, for example, here in Germany.
Let's look at the relative attractiveness of, say, the DAX versus perhaps other markets. Do you think there's much value? Because clearly we have seen a lot of profit warnings going on for the market, etc. So it's a good time to buy into?
Well, the DAX index, I should say two things. Firstly, it's a very cheap index, although that's not only true in Germany, it's true in many other European markets as well. The discount of valuation on a price-earnings basis, for example, compared to the US is nearly 50%, and this is among the biggest discounts we've seen historically. But we should also say that the DAX and other European markets are made up of a composition of different exposures. Domestically exposed parts of the market have weakened quite a lot because the domestic economy here has been weak, but some of the big global parts of the market and technology companies, for example, have been doing very well. So actually the DAX index is not a very good representation of the German market and indeed is, performed well this year. And I think that, global companies with products that are competitive in the global marketplace are really not impacted so much by the domestic conditions. Of course, there are other specific headwinds in certain industries which have faced increased competitive pressure. You mentioned the auto sector, for example. But overall, I think the DAX index and European indices have pockets of very attractive value in globally exposed competitive companies.
Yeah, which sectors do you think are attractive? Because it's kind of tricky to choose because of pick.
Yeah. Well, our view has generally been in Europe to have a sort of barbell, a composition between quality growth companies and things like healthcare and technology, areas where you're seeing continued increased demand and an ability to compound cash flows, but also some deep value areas. We've like banks, for example. They're very cheap. Net interest margins are improving. These companies are paying dividends, are buying back shares. And I think as interest rates come down, some more heavily levered or indebted sectors will see some relief. Telecoms would be a good example of that. So I think we're recommending a bit of an eclectic mix, really, of different styles and areas between growth and value, where we think there's reasonable opportunities to see a mix between some growth as well as reasonable valuations.